There's a moment every trader reaches when charts stop looking like opportunities and start looking like chaos. Lines, wicks, and candles seem to dance with no rhythm, no mercy. But that's only because you're watching the surface, the price. The real story is underneath, in the current that moves everything. Liquidity. Liquidity is not a technical concept, it's a psychological one. It's the collective behavior of traders. Their fear, their greed, their hesitation, expressed in the form of orders. Every market move, every breakout, every false reversal is liquidity doing what it does best, seeking out imbalance. The market is always hungry, and what it feeds on is commitment. Every time a trader believes the market must go in one direction, liquidity takes note. Think about this. The market doesn't move to reward you. It moves to fill orders. That's all. It's not punishing or rewarding. It's simply doing what it was designed to do. When you begin to think like this, you stop personalizing outcomes. You stop fighting the market. You start aligning with the flow of liquidity, the true driver of price. Every fake breakout, every stop hunt, every reversal that makes traders scream manipulation is not manipulation at all. It's structure. It's the market doing its job. It moves where the liquidity is, because that's where the most emotion lives. The herd places stops in predictable zones, and the market uses that liquidity to continue its path. If you can see that, not react to it, not judge it, but see it, you begin to think like the entities that move the market, not the traders being moved by it. Liquidity exists in layers. Retail traders look for confirmation, smart money looks for liquidity. One is chasing validation, the other is harvesting emotion. The best traders understand that price only travels from one pool of liquidity to the next. Nothing more. Your task isn't to predict where it will go. It's to recognize where the next pool lies and wait for it to get there. Discipline in trading liquidity is about patience. The market will always come for liquidity because it has to. Your job is not to chase it, but to let it come to you. Wait for the market to collect stops, to sweep zones, to create imbalance, and then step in when the emotional traders are being flushed out. That's where your edge is. Liquidity trading isn't about magic zones or perfect indicators. It's about understanding that behind every candle is a crowd, and behind every crowd is emotion. Learn to read that emotion, and you'll stop fearing volatility. You'll see that volatility is opportunity disguised as uncertainty. Remember, the market is neutral, but traders aren't. Liquidity reveals where imbalance lives, where fear and greed overlap. Your consistency will come when you stop trying to beat the market and start listening to its rhythm. Every fake out, every trap, every reversal is the market whispering, "Here lies emotion." The best strategies aren't complicated, they're simple but counterintuitive. They require you to do what few can. Wait for others to act emotionally and then act rationally. The liquidity hunter doesn't chase movement. He anticipates exhaustion. He knows that once the emotional traders are done, equilibrium must return. And that's where precision lives. So learn to read liquidity not as data, but as dialogue. The market is speaking every second, revealing the next move to those who can hear. Don't trade price, trade the psychology behind it. Don't seek confirmation, seek clarity. In the end, mastering liquidity means mastering yourself, because the market's liquidity flows where the crowd believes certainty exists. And once you detach from that belief, once you learn to stay neutral, patient, and observant, you'll discover that liquidity isn't hiding from you. It's been guiding you all along. Liquidity is the language of the market's intent. If you learn to read it, you will never again be confused by what the market does. Price will stop being a mystery. You will see that behind every move, every candle, every sudden spike or silent drift, there is a reason, not a secret, not manipulation, but pure market logic expressed through liquidity. Liquidity is not about lines on a chart or hidden algorithms. It's about energy. It's the fuel the market requires to move. Without it, nothing happens. With it, everything happens, suddenly, violently, beautifully. Most traders look for patterns, signals, or indicators. They chase the appearance of certainty. But the market doesn't communicate certainty, it communicates intent. And intent can only be found in liquidity. Every buy order needs a seller. Every breakout needs trapped traders. Every move requires liquidity to fill it. When the market moves, it's not random. It's revealing where the energy of participation lives. Liquidity tells you where belief is concentrated. It's where traders commit, where they decide, where they expose themselves emotionally. When price consolidates, Liquidity builds up. Traders become impatient. They place stops. They place pending orders. The market, meanwhile, waits, silent, calculating, patient. Then suddenly, it moves, and everyone thinks something happened. But nothing new happened. The market simply reached a point where enough liquidity existed to justify motion. The breakout wasn't a surprise. It was inevitable. The more you understand liquidity, the more you realize how predictable market movement really is. Not in direction, but in behavior. Price moves where it must move to find balance between buyers and sellers. That balance doesn't come from fairness. It comes from need. The market's intent is always to seek out liquidity. It's how it breathes. It's how it survives. And the more emotion behind that liquidity, the more forceful the movement. Think of liquidity as communication. When you see a sharp rejection, the market is saying, there was no interest here. When you see a sweep of highs followed by a reversal, it's saying we've consumed liquidity, now we can move the other way. Each wick, each spike, each stall is part of the market's language, but most traders never learn to translate it because they're too focused on reacting instead of observing. The secret is detachment. You can't read intent while you're emotionally attached to outcome, if you want to understand. Liquidity, you have to watch the market like a scientist, not like a gambler. When you trade emotionally, every movement feels personal. When you trade with understanding, every movement feels logical. Liquidity becomes a map, not a threat. The market's intent is not hidden in price action, it is price action. Every move is a quest for liquidity. Every trend is a chain reaction of imbalances. When the market pushes higher, it's not because buyers are strong. It's because buy-side liquidity is being consumed, and new liquidity, stop losses, pending orders, exist just beyond that range. Once those areas are filled, momentum fades, and the market seeks the next pool of liquidity. It's a never-ending cycle of absorption and displacement. When you learn to see that, you stop guessing. You start anticipating. Not predicting direction, but predicting behavior. You know where the crowd has placed their stops. You know where they feel safe. And because you know that safety is illusion, you know that's where the market must eventually go. Liquidity always hides in the same places. Above highs, below lows, around consolidation zones, beneath fear, and beyond greed. The market is efficient not because it's fair, but because it knows how to exploit emotion perfectly. Liquidity reveals how traders think. Every stop loss, every entry, every target placed is a psychological decision. It's the trader saying, I'm confident here, or I can't take pain beyond this. The market listens to that. It doesn't care about your conviction. It cares about your exposure. Liquidity forms where exposure gathers. That's why you often see the market push just far enough to trigger emotional response before reversing. It's not manipulation, it's fulfillment. The market is simply filling the emotional orders of those who forgot that uncertainty is the rule, not the exception. Most traders fail not because they can't find good entries, but because they don't understand what price movement means. They think volatility is chaos. They think stop hunts are unfair. But all of these are liquidity events. When you see a candle spike into a known level and reverse, the market isn't punishing anyone. It's communicating. It's saying, we've cleared the emotional imbalance here. Now the path is open. Understanding liquidity changes how you perceive risk. You stop fearing drawdown because you know it's part of the process of liquidity seeking. You stop chasing trades because you know the market will come to your level once enough liquidity is available. You stop overtrading because you realize that waiting is the ultimate edge. Liquidity teaches patience. It teaches respect for timing. It teaches surrender to structure. But more than anything, liquidity teaches neutrality. You begin to see that the market is neither good nor bad. It's neutral energy responding to participation. You stop arguing with it. You stop trying to outsmart it. You start listening. And in that silence, you begin to see intent unfold naturally. Liquidity exists in every time frame, every market, every session. It's not unique to Forex or stocks or crypto. It's universal because it's built on human behavior. People want to win. People hate losing. People chase certainty and flee discomfort. Liquidity flows toward those emotions. The market harvests them. If you can observe that without judgment, you can align with it without friction. You'll notice something profound. Liquidity builds where confidence grows. The more convinced the crowd becomes, the more liquidity concentrates in one direction. That's why the most painful reversals happen right after traders feel most secure. The crowd buys into the illusion of control, and the market, in its cold efficiency, uses that confidence as fuel. It's not personal, it's structural. The experienced trader doesn't fight liquidity. They track it, respect it, and let it reveal timing. They understand that the market's intent is not about direction. It's about efficiency. The market doesn't care about right or wrong. It cares about balance. When imbalance exists, it moves to correct it. When balance returns, it pauses. Every rally, every drop, every consolidation is a reflection of that ongoing dialogue. When you learn this language, your relationship with the market changes. You stop needing to know what happens next and start focusing on why it must happen. You realize that trading isn't about control. It's about cooperation. The best trades don't come from analysis. They come from alignment. You align yourself with the path of least resistance, which is always the path of greatest liquidity. The irony is that most traders search for secret strategies, unaware that the secret is visible every day. It's in the way price behaves around obvious levels. It's in the way candles form traps, then reverse. It's in the repeated patterns of panic and relief that define every session. Liquidity doesn't hide, it waits to be recognized. If you observe price long enough, you'll start to feel its rhythm. You'll sense when liquidity is building. You'll feel the tension before a move, not because of indicators, but because you can sense imbalance. That's intuition built on observation, not prediction. That's when trading becomes art. To trade liquidity effectively, you must trust process over profit. You must accept that you'll never know exactly when or how far price will move, but you can know why. And knowing why is what keeps you disciplined when others panic. Liquidity gives context to uncertainty. It transforms randomness into structure. The true power of liquidity awareness lies not in predicting price, but in predicting reaction. You can anticipate where traders will be forced to act, where stops will trigger, where orders will fill, where emotions will peak. Once you can see that, you stop reacting to the market and start allowing the market to reveal itself to you. Patience becomes your greatest weapon. The liquidity-driven trader knows that every emotional move must eventually exhaust itself. Every manipulation must end. Every trap must complete. All you have to do is wait for the energy to shift, for the liquidity to be consumed, and for the imbalance to reverse. The market always gives signals, but only to those patient enough to let them form. Liquidity is intent. It is the market's truth told through action, not words. When you learn to read it, you no longer fear what you don't understand. You no longer need to guess. You see that every spike, every sweep, every reversal is the market saying, I needed this energy to move forward. And that realization transforms trading from an emotional battle into a mental dialogue. Once you master liquidity, you realize something extraordinary. Trading success was never about being right. It was about understanding what drives the wrong decisions of others. Liquidity exposes that. It's the mirror reflecting crowd psychology. The market rewards those who can read that reflection without projecting their own bias onto it. Liquidity is the market's language of intent, and the fluent trader listens, not reacts. They don't impose their will, they interpret reality. They see through chaos to structure, through emotion to equilibrium, and in that clarity they find what every trader ultimately seeks: consistency. Because when you trade in harmony with liquidity, you are no longer guessing what the market will do. You are flowing with what it must do. The market moves to find willing participants, not fair prices. That single truth separates those who chase understanding from those who chase illusion. The idea of a fair price is comforting. It gives traders the illusion of order, of balance, of justice. But the market doesn't exist to be fair. It exists to facilitate transactions, to bring together buyers and sellers, to create movement where there is interest, and to destroy belief where there is complacency. The market is not a democracy, it's an auction. And in that auction, the only thing that matters is participation. Every tick, every candle, every fluctuation represents the market's search for liquidity. It's not asking what's the right price. It's asking who's willing to trade here. When there are no willing participants, the market moves up, down, through your stop, beyond your logic, until it finds them. This is the mechanism that keeps the system alive. Price isn't a reflection of value, it's a reflection of agreement. The market only stops moving when it has found enough agreement for both sides to transact comfortably. Then, when that comfort dissolves, it moves again. Traders who cling to the idea of fair value struggle endlessly. They think the market should respect levels, or should reverse where it's overbought or oversold. They think price will revert to fairness. But the market doesn't owe fairness to anyone. It owes motion to everyone. What looks like overextension to one trader is opportunity to another. What looks like manipulation is simply the market searching for more participants willing to make emotional decisions. The reason most traders lose is because they mistake fairness for equilibrium. They assume the market cares about their logic. It doesn't, it only cares about their orders. And your orders, like everyone else's, are liquidity. The market will find them, fill them, and move on. If you understand that, you stop trying to predict what's right and start observing what's necessary. The market is designed to move where unexecuted orders exist. That means wherever traders feel most certain, stops will be waiting nearby. The market seeks those stops, not because it's malicious, but because that's where participation hides. A breakout doesn't occur because the market suddenly decided to trend. It occurs because price reached an area filled with resting orders waiting to be triggered. Once those orders are executed, liquidity has been consumed, and the market moves again to find the next pool. Fairness is an illusion created by our desire for control. We crave balance because imbalance makes us uncomfortable, but imbalance is what creates opportunity. The market doesn't correct to fairness, it corrects to fill when it can no longer find enough willing participants in one direction. It must move in the other to awaken new interest. That's why trends reverse at points of exhaustion. It's not sentiment changing, it's participation drying up. If you watch the market closely, you'll see this rhythm everywhere. A rally slows, not because the market should fall, but because the participants willing to buy at that level have already done so. There are no buyers left. The market then seeks out sellers by moving lower until it finds them. When too many sellers enter, it reverses again, not because of fairness, but because now there's fresh liquidity above. The cycle continues endlessly. It's not logic, it's flow. The best traders understand that their job is not to find fair prices, but to follow participation. You must think like the market thinks. Where are the orders? Where will emotion force action? Where will traders feel pain and be willing to engage? Because the market feeds on engagement. It needs energy to move, and human emotion is its most renewable source. Fear and greed are what drive volume. When you trade with this awareness, you stop expecting stability. You stop expecting the market to respect your levels or reward your patience. You begin to see that the market's entire purpose is to find activity, not to validate your analysis. You don't argue with it, you listen to it. The market is a constant conversation between willingness and exhaustion. It goes where people are willing to bet, and it leaves where they refuse to act. Every spike that takes you out before a move in your direction, every stop hunt, every painful whipsaw has a single purpose: to find willing participants. It's not personal, it's structural. The market must trigger emotion to generate energy. Without that energy, price cannot move. This is why volatility is born out of fear, not logic. It's why markets rally hardest when traders least believe in it, and collapse fastest when confidence peaks. Fairness belongs to textbooks. Participation belongs to reality. The market doesn't care if something is too high or too low. It cares whether there's someone left to take the other side of the trade. When no one will, it shifts. When everyone will, it traps. You can see this in every exhaustion top, every panic bottom. Once the crowd is fully engaged, there's no one left to sustain the move. The market, needing new participants, reverses. The intelligent trader doesn't chase confirmation, they chase imbalance. They understand that the market must lure in traders before it can move against them. That's why trends build slowly and collapse quickly. That's why liquidity zones form. Where emotions peak, the market must attract enough willing participants to justify its next move. When it has them, it moves without mercy. Trading becomes easier when you stop trying to impose your version of fairness on the market. You stop expecting it to behave rationally because you realize it's not a rational system. It's a system of human behavior reflected through price. And human behavior is always emotional, reactive, inconsistent. The market's motion mirrors that inconsistency perfectly. So what does this mean for you as a trader? It means you must stop chasing equilibrium and start following imbalance. Stop asking, is this fair? And start asking, who's trapped here? Because wherever there's trapped emotion, there's liquidity waiting to be released. And when liquidity releases, price moves, not because of logic, but because the market found willing participants who are forced to act. The market doesn't move because of numbers or indicators. It moves because of people. Every candle tells a story of commitment and regret. Buyers trapped above highs, sellers stuck below lows, breakout traders believing they've caught the next move. All of them are participants. The market collects them, uses their emotion as energy, and moves forward. Once you see this clearly, trading stops being emotional. You realize your role is not to be right, but to interpret the flow of participation. You don't fight the market's movement. You observe where it must go next to find new engagement. You stop being part of the crowd and start reading the crowd. That's when consistency begins. Price does not seek justice. It seeks purpose. It seeks action. The concept of fair value belongs to fundamental models, not living markets. In a live market, fairness is irrelevant. All that matters is who's willing to act at this moment. The market will push until it finds enough action to fill its appetite. It's why price doesn't stop at your resistance line. It slices through, consumes liquidity, and reverses. It's why perfect setups fail. They attract too many of the same type of participants, leaving the market starved for fresh liquidity. When everyone is positioned the same way, there's no one left to trade with. The market then does what it must. It moves in the opposite direction to create imbalance again. The crowd sees this as manipulation. The disciplined trader sees it as structure. The market isn't tricking anyone, it's simply doing what it's designed to do: find willing participants. The ones who understand this trade with patience, because they know the market will always seek out emotional zones. The ones who don't chase the illusion of fairness and end up being the liquidity the market was searching for. Every major market move begins with disbelief. That's because the market moves away from consensus, not toward it. Consensus is comfort, and comfort is low liquidity. When everyone agrees, there's no tension, no energy, no participation. The market must go where disagreement exists, because disagreement fuels trade. The best opportunities always live where conviction divides, not where it aligns. This is why your greatest enemy as a trader is not volatility, but expectation. Expectation blinds you to the fact that the market doesn't owe you symmetry, it owes you opportunity, and opportunity comes from imbalance. When you let go of needing fairness, you finally see what's truly happening. You see a living system searching for participation, not perfection. The market moves to find willing participants, not fair prices. The sooner you internalize that, the sooner you'll stop reacting to noise and start recognizing intent. You'll see the market's constant quest for engagement, the ebb and flow of emotion behind every candle. You'll begin to understand why it spikes where it does, why it consolidates, why it reverses. This awareness doesn't give you control, it gives you clarity. You realize the market doesn't move against you. It moves because of you, because of all of us collectively feeding it with emotion, fear, and desire. Once you stop feeding it and start observing it, you stand apart. You stop being hunted liquidity and start being patient liquidity, the kind that waits for opportunity to come instead of chasing it. In that patience, you find power. You let the market move first. You let it expose where participation gathers. You let it show where emotion lives. And then, when the crowd is trapped and conviction turns to confusion, you step in, not because it's fair, but because the imbalance has reached exhaustion. That's trading at its highest level, detached, focused, calm. You're no longer searching for fairness, you're following flow. You're no longer judging the market, you're listening to it. Because the market doesn't care about fairness, it only cares about participation. And when you learn to trade from that truth, you stop being a participant who reacts and become an observer who profits. Trade where liquidity creates emotion, not where it creates noise. That single distinction separates the trader who reacts from the trader who responds, the gambler from the professional. The market is constantly filled with movement. Candles flashing, orders flowing, prices shifting every second. But not every movement matters. Most of it is noise. Meaningless fluctuations designed not by manipulation, but by the natural breathing of a living market. Noise distracts. Emotion directs. The key is learning to tell the difference. Liquidity is everywhere, but not all liquidity holds significance. Some is mechanical, market makers balancing books, algorithms executing neutral flows. That kind of liquidity creates noise, movement without meaning. But there are moments when liquidity builds for a deeper reason, because traders are emotionally involved. They're fearful, greedy, uncertain, desperate. That's when liquidity becomes meaningful. That's where price becomes predictable, not by logic, but by psychology. The market at its core is a mirror of collective emotion. It moves not because of charts or indicators, but because of people, and people, when exposed to uncertainty, behave predictably. They overcommit, they panic, they hope. Liquidity pools form where emotion is strongest, above recent highs, where traders place stops in fear below recent lows, where they believe safety lies around breakouts, where they feel excitement These are not random zones, they are emotional footprints. Trading where liquidity creates emotion means positioning yourself where those emotional reactions will take place, not where mechanical noise distracts you. The difference lies in awareness. The average trader mistakes movement for opportunity. They chase candles, thinking motion equals potential. The professional waits for emotional buildup. They know the real opportunity comes when liquidity aligns with emotion. When the crowd can't help but act, the market doesn't move because it's rational. It moves because traders are emotional. Liquidity simply exposes where those emotions lie. When price approaches a level packed with stop losses or breakout orders, tension builds, traders feel anticipation, fear of missing out, fear of loss. That tension is energy, and the market feeds on it. When enough emotion accumulates, price bursts through that zone, clearing liquidity and leaving confusion in its wake. The professional trader doesn't chase that move. They anticipate it. They know the emotional reaction will be temporary, and once it exhausts, equilibrium will return. Trading where emotion drives, liquidity is about patience and timing. It's about waiting for the market to show you where participants are psychologically vulnerable. Because where traders are emotional, they're predictable, and predictable behavior is opportunity. Look at any chart, really look, and you'll see the same pattern repeating endlessly. A price consolidates, traders become impatient, and they begin guessing the next move. Some enter early, some place stops just outside the range. Liquidity builds on both sides. Then, a sudden breakout occurs. Price pierces through one side, triggering stops, inviting emotional entries, and within moments, reverses. To the untrained eye, that looks like manipulation. To the trained observer, that's the market feeding on emotion. It went to where liquidity and emotion overlapped most intensely. Trading noise, on the other hand, is reacting to every fluctuation, every meaningless candle. It's trading movement without context. The noisy trader looks at a 5-minute spike and believes a trend is forming. The aware trader sees it as a symptom of liquidity redistribution. Nothing more. Noise invites ego. Emotion invites opportunity. The reason most traders lose is that they confuse emotional noise with emotional significance. They trade too often because they need to feel involved. The market's constant motion triggers their impatience. They think activity equals progress. But trading frequently doesn't mean trading intelligently. The most powerful trades happen at emotional extremes. Where liquidity is gathered and emotion is peaked, those moments are rare, but they're meaningful. To trade where liquidity creates emotion, you must learn to read tension. Tension builds slowly. It's visible in structure, in compression, in narrowing volatility. The market is waiting, building pressure. Participants become restless. The more time price spends consolidating, the more emotion accumulates. When it breaks, that energy releases explosively. The noise trader sees the breakout and chases it. The emotional liquidity trader sees the buildup and anticipates where the energy will discharge. They trade the reaction, not the event. Emotion gives liquidity direction. Noise gives it confusion. When you align yourself with emotion-driven liquidity, you're trading human behavior, not random motion. You're observing where traders will be forced to make decisions under stress. You're trading the release of emotion, not the expression of it. Think about what happens during a stop hunt. A market makes a slow grind up, building confidence. Traders buy, their stops sit just below the swing low. Price then suddenly dips, taking them out, triggering panic, filling sell orders, only to reverse upward again. That's not randomness. That's emotion-based liquidity. The market used emotion to generate liquidity. It created fear to create participation. The noise trader calls it unfair. The professional calls it structure. Every great trade begins with recognizing where liquidity and emotion intersect. Those are the zones where price tells the truth about the market's psychology. A clean breakout through an emotional zone is not manipulation, it's completion. The market needed those orders to move, and emotion provided them. When the flush happens, clarity follows. You must train yourself to recognize the difference between emotional liquidity and mechanical noise. Noise is erratic, but shallow. It lacks buildup. It's short-lived movement within balance where no one is emotionally trapped. Emotional liquidity, however, is heavy. It comes after expectation is built, after hope or fear has taken hold. That's why emotional moves leave footprints, strong reactions, large wicks, volume spikes. To find emotional liquidity, ask yourself, where will traders feel something? Where will they experience relief, regret, or panic? Those are your areas of interest, not the random wiggles in between. Price might move for hours without meaning, and then, in seconds, everything changes. Because emotion enters the equation. That's when the market speaks clearly. Trading emotion-driven liquidity is not about being smarter, it's about being calmer. You must be emotionally neutral to see where others are emotional. You must stand still while others are reacting. The professional trader doesn't trade emotion, they trade against it. When others are euphoric, they're cautious. When others are fearful, they're curious. Because they understand the market's job is to exploit emotion to generate movement. Noise seduces traders because it feels alive. There's constant activity, constant stimulation. But that's exactly why it destroys discipline. The trader who reacts to every twitch forgets that the market is designed to invite participation through uncertainty. Noise feeds impatience. Emotion rewards patience. The greatest opportunities don't appear in constant motion. They appear in moments of climax, when the crowd can no longer resist acting. Liquidity and emotion are partners in a dance that repeats forever. Liquidity provides the structure, emotion provides the energy. The market uses emotion to access liquidity and uses liquidity to justify movement. Understanding this cycle frees you from chasing randomness. You realize your job isn't to catch every move. It's to wait for the moves that must happen because emotion guarantees they will. When you begin to observe markets this way, you see that price is merely a reflection of collective belief. Every chart pattern, every spike, every reversal is the outcome of emotional consensus being formed and destroyed. You stop treating trading as prediction and start treating it as interpretation. You don't need to know the future. You only need to know where emotion hides today. The market speaks a simple truth. It will always move to hurt the most people possible in the shortest time. That's not cruelty, it's mechanics. Because emotion equals liquidity, and liquidity equals movement. So when traders are trapped in comfort, the market will disturb them. When they're certain, it will confuse them. When they're panicked, it will tempt them. The professional trader watches this cycle unfold and profits not from guessing, but from understanding. Trading noise is like trying to hear music through static. Trading emotion is like hearing rhythm through chaos. You can feel it. You know when something real is about to happen. It's the tightening before a release, the stillness before the storm. You can sense when the market is building emotion because participation slows down and tension rises. Then, suddenly, volatility explodes. And if you were patient, that's your moment. Emotion-based liquidity leaves tracks. You see it in failed breakouts, liquidity sweeps, false reversals, and exhaustion wicks. Each one is a conversation between the market and the emotional trader. The market asks, "Are you sure?" And the crowd answers with conviction. Then, once they're committed, the market uses their conviction as liquidity and reverses. This is not manipulation, it's structure. Noise traders react to the surface. Emotional liquidity traders respond to the depth. They see that every extreme movement is built on human reaction. And once that reaction is spent, the market must rebalance. That's where the edge lies. Not in chasing the move, but in catching the return to balance. To trade where liquidity creates emotion, you must master observation and patience. Observation to see where energy builds. Patience to wait for the crowd to commit. Once emotion is visible, once the market has exposed where participants are trapped, you step in, not emotionally but logically. You're not fighting the market. You're flowing with its necessity. The art of trading is not about finding certainty, it's about finding emotion. Because where emotion exists, certainty collapses. And when certainty collapses, liquidity floods. That's your opportunity. That's when the market is telling the truth. Noise is temporary. Emotion is eternal. The market structure will change. Algorithms will evolve. Instruments will shift. But emotion will always drive liquidity. If you can learn to trade where emotion meets liquidity, you will always be one step ahead of those trading where emotion meets noise. Trade where liquidity creates emotion, not where it creates noise. Because noise fades, but emotion leaves footprints. And footprints, if you're calm enough to see them, always lead to opportunity. In the end, trading is not about chasing movement, but understanding meaning. Liquidity reveals where emotion hides, and emotion reveals where opportunity lives. When you learn to trade where liquidity creates emotion, you stop reacting to every flicker of price and start responding to the rhythm of the market's intent. Noise fades, but emotional footprints endure. The trader who waits for emotion-driven liquidity doesn't compete with the crowd. They observe it, align with it, and profit from its inevitability. Master that, and the market stops being chaos, it becomes conversation.